It's about that time, Cam Pop. Oh, let's get it going. It's going to be an interesting show, a lively one. I was admittedly very pissed off this morning because I thought there was some market manipulation going on. I'm still unclear whether the market manipulation is going on, but neither here nor there. Welcome back to the Higher Standard Live. I am your host, Chris Nahibi, and this is the show where we aim to give you everything that CNBC can give you in a single 8-hour session of the afternoon in a truncated 1-hour-long period. But we also incorporate things like behavioral economics. We're going to look at the social sphere, give you an opportunity to engage with us, and of course, be collaborative on this little adventure that we ride together on. And it is brought to you by the team over at Fridays. You can go to www.joinfridays.com, use code HIGHER. You get $100 off your first order. I personally microdose tirzepatide as well as take NAD Plus for them. Really spectacular for longevity. And probably the only reason I can keep this thing going for an hour some days because, man, I am not sleeping super well. Okay, so we do have proprietary models. If you've been watching the show before, you know that we use them quite heavily in the beginning to lay out the framework of what the day is going to look like and what we're experiencing throughout the day. We're going to look at volatility. We're going to look at the Fed's liquidity position. We're going to look at home affordability. We're going to look sector by sector, and then we're going to get into the social sphere, what's going on both Instagram and X as a proxy for the behavioral rhetoric that we're seeing that's out there, because a lot of these news reports you see on the major channels aren't going to give you feedback in real time as far as how the human population is responding. They're only going to tell you what their narrative is. We're here to give you the truth and to break down all the cheeky shenanigans. So with no further ado, right in to the day. Now, this to me was fascinating. We are in a mixed market day. This is our market status chart, which is kind of compelling because the day after the war in Iran was announced, we saw a narrow tech-led rally. Yesterday, we saw a bit of an escalation. And here we are today in between kind of a narrow tech-led rally and a mixed day. There's clearly no trend. This chart is going to be carried through with us as we look at the sector-by-sector analysis. You will see the exact same overall market summary based on this. But all the major indices, as we see here, as using ETFs as a proxy, are up on the day, showing an overall resiliency. Now, if you're like me and you woke up this morning, you're thinking, what? This is bullshit. Major escalations in war overnight. how in the actual hell, I got to fix this camera angle here, can we have a positive market and a positive spin and a positive rhetoric when there's so much bad stuff happening in the world? And well, we saw the Korean market take a dive last night, and I thought, okay, this is going to bleed over. We're going to have some interesting things happen. I'm going to break down, with a non-political perspective, mind you, what's happening in Iran, what's happening in the media, what's happening in Korea, and how I think all of these things are intertwined, and we're seeing something that clearly appears to be manipulated and at the very least questionable. And I'm not necessarily favoring one side or the other politically as much as I would just like answers to some of these questions, because it leads me to feel, I'm using the operative word, feel, that the market is being clearly manipulated for reasons that make no sense at all to me whatsoever. So you would think normally that during wars that the market would be, I don't know, afraid, volatile, if you will. And as a result of that, you would expect to see something like our synthetic volatility index go down, which would show you the market going from calm into panic mode, depending on where it's at on this gradient here. Now, the score, as you see, is 82. It's actually improved since our show on Monday. So, announced a war over the weekend, took out the Ayatollah with American attacks, and then what happened subsequently? The market was showing a little bit more fear. We saw the volatility index, the VIX, which is what what the market traditionally uses to be the fear gauge. We saw that rise. Okay, well, it rose, no big deal. Well, it rose to above 20, and I think anything above 20 is worrisome. And for those of you who are wondering, oh, Chris, where is it at today? It is still at above 20. Here you go. Okay, so there is still some elevated fear, and I think that's reasonable. I'm actually shocked this is so low in the markets, but ours is a little bit more sensitive to the dial than what I would call the VIX is. So our synthetic volatility index is going to look at realized volatility through the day, intra-range stress on the different markets, again, using ETFs as a proxy. It's going to look at some gap risk analysis and then give you some cross-market volatility as well. We've actually seen an improvement in the overall risk profile from that Monday show, as I referenced earlier, where we were in the high 70s, now to the high 82, in what is described as a narrowly calm market. Anything above 80 is considered to be a calm market for the modeling purposes. And at the same time, we've had the Fed dumping liquidity into the system. So here you go. We're still in a tense position, but the Fed balance sheet is still very healthy and positive. Net liquidity level is a drain. This is a slight improvement from the 6 rating it was at before. But the Treasury account appears to be increasingly supportive. So really, it's this one up top here, the Fed balance sheet minusing the other two to get you your net liquidity score. We're in a tense position, but we are approaching supportive now from the FOMC. And there is some news on that front. Warsh was confirmed to be the choice of the president for that. We will get into that when we get into the XAI analytics section. But certainly, we're going to see some Fed dumping of money into the market. We're going to see more rhetoric around the new potential FOMC head, including his background. He still has to be confirmed and all those things that are fun. But we'll see that pressure there. But I don't think you're going to see any meaningful change in the movement of the rates, despite the fact that Myron, Fed Chair Myron, came out recently and said that he believed that a rate cut is due. Shocker, he's been the most bullish on rate cuts in most recent days. But where we last left off with the Fed Watch tool, Chicago Mercantile Exchange Fed Watch tool, was over a 97% probability of an interest rate cut not happening. And that interest rate probability has not changed. There you go. So despite all the rhetoric, despite all the things that have happened, we are meaningfully no different than what we were on Monday from an overall probability of an interest rate cut. It seems that we are not going to see a significant rate cut in the next meeting, which is March 18th. I think that's in line. I think that's right. We are seeing some interesting data. We got a data print today which showed that jobs were above expectations by over 10,000 jobs. I think the expectation was 50. I think we got 63. We'll get into that here on one of the data prints when we look at the calendar here shortly. So we are seeing, frankly, a level of stability, which normally is a good thing. And normally you'd be watching the show going, well, Chris, you're saying the market's stable. Things are great. Why are you so upset? And, what's the kerfuffle about? Well, it's bullshit. We're in a wartime scenario. Volatility is normal in the markets. Why are we seeing all this positivity? Why are we seeing this stability? Why is the market in seeming disbelief? And I'll tell you, there's a lot of good things that are happening in some spaces. If you're a crypto fan, we got a lot for you this show. You got Kraken, which just got access to the Fed, which was a bit surprising to me. You got Coinbase now trading stocks, and it's got a pretty crazy day. And Bitcoin's back. Bitcoin is back, baby. I'm sure, Said, wherever you are, you're probably tearing up a little bit emotionally inside. Moment of silence for Said. Why? Oh, let me explain. Said is, he's got wet paper towel hands. And because he has wet paper towel hands, he's been, well, a little happier than normal, a little pep in his step as of late because Bitcoin had been traded down to $68 from its high, well above that. And now here we are, a rebound, $5,417.08, largely because of the news that I just made reference to. We're going to go over that here whenever we get to the XAI and look over the behavioral economics and some of the trending topics. We're going to spend some time diving into that and why this is a meaningful pivot in the economic sphere. So I think you're going to see this continue to grow as we start to see some of these developments really hit mainstream. And obviously the Jane Street fallout has seemed to stop the 10 a.m. slump that we saw over a prolonged period of time. So there's a lot there. Let's get into the housing affordability matrix. Home affordability is still stretched. We're not seeing meaningful improvement here. Keep in mind, this is a lagging indicator. That this information does come from the St. Louis Fed's API, and because of that, I don't think this is indicative of what we're going to see. We are going to see a bit of a bump because we saw rates drop over the last couple of weeks, the 10-year in particular, and because of that drop in the 10-year, we saw mortgage rates improve meaningfully for a period of time. So I think you're going to see a blip up. It's going to look like, nothing, a blip up in mortgage rate activity, then come back down is my approximation, if I'm being very rudimentary about it. I'm sure if Logan from Housing Wire were to see my chart work here, he'd probably be vomiting on himself a little bit. Shout out to Logan. I am not a housing expert like him, but I pretend to be on TV. Here we go to the 10-year. The Treasury sitting at a nice 4.079. It has actually increased, but if you look at it over the course of, let's say, a little bit different spectrum of time, which we like to do here because the way you look at things really matters. You've seen some volatility in this space. Here you go. You can see it here. A little bit of volatility, but nothing that I would say is crazy compared to what it could be volatility-wise in the market. We saw a spike up there. I want to say that was about 410. Yeah, about 409-ish. And again, down, we're sitting here. So we're not trading at session highs. We're not trading at session lows. We're right there in the middle at a 4.07 number. So I think that benefit in the 30-year mortgage rate that we saw rates creep just below 6% is going to go away. We're going to sit somewhere right about above 6% again over time. So again, housing affordability not improved a whole lot according to this chart. I think you're going to see some incremental stuff there. But again, I say it on every show, supply is not the biggest limitation on affordability in this particular. It's important, but it's not the biggest limitation right now. Rates and cost of homes have a bigger impact. And yes, home prices, affordability, a function of supply and demand. Yeah. Another show, you guys, all the haters can get at me. We're going to do that at a different time. Let's get into the macros, baby. Macro Fed watch of events. Here you have some pretty interesting stuff that's coming out today. We got the mortgage 30-year rate information coming out, ADP change. We're going to talk about that. ISM servicing PMI and Jolt job openings came out today. We're going to talk about those. Friday, we got non-farm payrolls, unemployment rate, and Michigan consumer sentiment. But we also have some interesting stuff coming out here in the not too distant future. FOMC rate decision will be next Wednesday. Sexy as that may be. And the press conference will, of course, be covered in our traditional THS sense, where I get in front of you, we look at CNBC, and we talk all the shit. We're going to do all of that on Wednesday of next week. So be prepared for a lively show. I don't expect there to be anything sexy going into it, other than the fact that there is wartime discussions that are going to constantly be in the headlines. But I do think we're going to see a lot of interesting conversations as it relates to tariffs and the FOMC and their decision. So in the the post-game press conference, the site likes to call it, we're going to have the FOMC talking about Warsh being named. We're going to have the FOMC talking about the war's impacts to the economy and if that does change their perspective. We're going to have the FOMC talking about inflation and tariffs and if we're seeing that pass through rate. And we're going to see a little bit of the political poking of Jerome Powell because he is coming towards the end of his term. I think he's got, February 18th. I think he's got one more meeting left, maybe two. I have to go back and check that, one or two at the most. And that's it. But he's still a voting member of the FOMC, but he's not the FOMC chair at that juncture. So a lot of things in motion for the FOMC and a lot of things that are in motion socially. So a lot to really unpack and think through over time. Let's get into the sectors, shall we, baby? Housing, home builders, rate sensitivity, demand. This is a sector of the market that is always rate sensitive. We saw them have some ups and downs as of late, but for right now, D.R. Horton, Lennar, Pulte Group, Toll Brothers, and NVR, the major home builders in the country, seem to be relatively flat on the day. Going back to our status, we are in a mixed day. There's no clear trend. We're not technically in a rally, but we're technically not in a defensive risk-off position, which is somewhat shocking for a wartime economy. And we'll spend some time talking about how I think this is wildly manipulated here in the not too distant future. So stick with me as we get this properly set up with enough information so you guys can look at this and go, okay, is Chris full of shit or is he not? The answer is yes, I am. but it's not because of this. And if you're watching the show and you think to yourself like, hey, man, can I comment? Yes, you can. You can comment all you want, and we can and likely will incorporate your comment on the show. So be as sassy as you want. A great example of that is my guy Samson out here. Here we go. Let me see. Go to the main screen. Love these, Chris. Well, we love you too. Can Pop, I made it. You did. Let's go to Sean here. Sean says, I bet markets all knew ahead of time that the plan of action being taken and the months leading up to the events is what caused the rise in gold and other commodities, tinfoil hat, or tinfoil hat if you choose. Yeah, I think there's a compelling argument to that theory. My theory is a little bit more, I don't know, dark, but certainly that there's, look, if we learn nothing from the Epstein files, it's that there is an elite class of people out there who know things they're not supposed to know, who have controls and connections to people they're not supposed to have connections to. So I don't know. The rules kind of seem off at this point, but certainly the prediction markets, Kalshi and Polymarket, who we do support, Polymarket down there at the bottom right there, live stream, baby, is going to tell you at all times where the market money is. And everybody seems to be okay with the idea of insider trading. As a matter of fact, they're seeing that there was some trading activity ahead of the war that took place over the weekend last weekend, that started last weekend, I should say, where there was some suspicious insider trading that took place there too. So yeah, I to your point, there's a lot of tinfoil hat that needs to go around. Oh, you corrected it. Oh, Pumpkin. We knew you meant Tin, not Timmy. But you guys remember Timmy from South Park? Blah, 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 Timmy. Is that still appropriate? You can do that anymore? I probably can't. Let's go over to Instagram. For those of you who are new to the show, Instagram cannot feed the comments over. What up, Vic? How you doing, Rosie? Consistent as always. I really appreciate you two. Every single show you guys are here. It means a whole hell of a lot to me. Thank you guys for coming over. Obviously, Samson and my team over there with Sean as well on the other side of things. And then there's a couple people on LinkedIn. You guys come over. I can't really feed all of your comments in. It's kind of a wonky how the API works there. But if you do comment on LinkedIn on the live event, it will feed into the show and I can drag your stuff over this way. It really depends on how and where you do that. And for my friends on X, an increasingly growing platform for us, believe it or not, which is kind of a strange thing for me to say, and Threads for that matter. Threads we can't stream on, but X is a really good platform. We do keep the lives on LinkedIn and on X. In YouTube, we put them on a legacy format because we can game the model and get more sexy eyes on our show. Oh, and I would be remiss if I didn't mention this guy, Syed Omar in the house. Everybody, markets are definitely pricing in quick de-escalation of the geopolitical events. Tough sell for me personally when the top officials and supreme leaders are no longer present, but what do I know? And I'm going to show you some inflammatory shit coming up here. It's going to be, it's going to make you go, what in the actual fuck kind of disinformation campaign is this? But I'll save that for a little bit. Oh yeah, and Saeed is in fact just a YouTuber. That's weird to say, right, dude? Like that's weird to say. Breaking news on CNBC over here, which it's economic news. Nothing that we're not going to cover on the show anyway. Okay, so let's get into the next part of the show. We're going to get back into the sector analysis here. So you've seen the housing sector. It seems to be modestly predictable as the same thing over and over and over again. We're going to get to the banks. Banks, are more credit sensitive. So this is credit condition told the market. We've believed in that this is going to be a market, that the portion of the market, the sector that's going to do well. JP Morgan's the only one that's down. It's incremental, but nothing really meaningful here. REITs and credit refinancing risk. If you're going to go into this sector in the not too distant future, look for those who are heavy in the data centers. Data center REITs, I think, are going to perform very well as traditional REITs. Commercial real estate, those who focus on REITs are going to wind up being better off for it. And look at Saeed's stubborn comment. Just won't go away. I'm going to clear that out. There we go. Bye-bye, Saeed's comment. Sorry, buddy. Okay, so let's look at the mega caps. Big day today. Lots of conversation. Amazon coming back a little bit there. Amazon's had a rough go of it. Let's spend some time looking at Amazon, shall we? But Apple, Microsoft, NVIDIA, Amazon, Alphabet, kind of interesting day. Apple announced a new product. They have a MacBook Neo, which is like a $600 starting price tag for them, which I've done some looking at. It looks like a pretty robust laptop for most students who are going to be doing work with it. So I'm actually really interested to see where that goes, frankly. But let's take a look a little bit in the stock charts here for my friends over at Amazon. This is Amazon today, trading near session highs around 218, but coming off a pretty steep low here. And I know you're thinking, well, why did you say they've had a rough go of it, Chris? Well, allow me to illustrate, shall we, kids? Boom, as they say in the market. This is their 3-month chart, and you can see they took a pretty heavy dive down over here and have not had a really great 3-month run, down 6.9%. Let's look at them in the course of 1 year. There you go. So over the course of 1 year, they're doing okay. Over the course of 3 months. And this is why long-term investing always pays dividends, right? You look at this in the 3 month span, you're like, oh, it's terrible. But you look, if you bought here, that 3 month span is somewhat irrelevant. You could have walked out profits here, but generally over time, this will look like that on a chart if you went out even further. So certainly, this is why we always tell people that longer term investing has got a better probability of success, and companies generally do better over time. And why? It's the fundamental way the market works. Everybody's expected to perform and outperform every single quarter. Although in some cases it doesn't always work. When you look at companies like Nvidia, who've now had earnings beats for 13 consecutive quarters, their stock price took a dive on the last time they announced. So a lot to unpack there. And I know you're thinking, well, Chris, is Amazon a good buy in this particular sense because it's showing some resilience and bouncing back? Well, we've got a forecast model that does that. What? How cool of a show is this? Here you go. Here's the outcome forecast model using Amazon as a proxy for it. It's saying right now that you should be in a setup phase for potential purchase of buying. This is what I would call in the mildly preferring a purchase here at 66%. A trade, you can make a trade now if you want to. It's not saying no. Instrument, buy shares. That's no options or puts, calls, or shorts and like that. You do expect to stay in this as a short trade based on the metrics that it's looking at right now. The risk level here is moderate. The factors impacting this are clearly identified on this. The macro chart says that the macro economy and the near-term economic events, think FOMC meeting, could have an impact on the markets. The actual market itself is trading pretty well and looks a little bit resilient. The symbol itself has had some volatility as of late, Amazon itself. And is there some event risk coming up? Yes, there is. But the synthetic volatility index is calm. Amazon's momentum in price performance in the last couple of days has been good, which is why we looked at the chart over the last couple of days. There has been some symbol volatility over the course of the last 3 months. So it is cautiously optimistic in telling you to trade this short term right now, not look at a longer duration hold until such time as we get past some of the upcoming economic events. I look at that and think to myself, it's always a good time to buy for long if your thoughts are there. But that's our forecast model, which, believe it or not, I'm just as shocked as you, actually seems to be working. And for those of you who go, okay, Chris, where does all this model stuff go that you're building here? Well, Said and I are working on a project, and that project is going to take all of this information, incorporate some agentic AI, give us some real-time feedback in a way that we can't do right now because we're always hands-on, pushing buttons and talking to one another, but certainly can make some really meaningful observations for a show like this. And then we're going to show you something that we are lovingly, affectionately calling our alpha. And if you're familiar with sites like Seeking Alpha and what they're basically seeking returns, well, we're going to seek returns on the show. This is not an investment advice show. We're not telling you to go out and do these things, but we are going to show you how we are going to do this and make money with it in real time. We promised that at the end of last year and certainly the beginning of this year, and we are very, very close. I got to get some agentic AI stuff finished up with our OpenClaw installation, but this will be a full open source business model. We're going to show you exactly how we do it. We're going to show you the money that we start with, and we're going to spend some time on this show, which is really what THS Live has always been about. It's always been about proof of concept and building models that we know are going to be valuable for you, not only because you can get a truncated version of what you're seeing in the markets here in approximately 1 hour, but also because we can show you how we are actually making money with this information. These talking heads on CNBC, they'll say stuff, it's objective, you don't see it. We're going to show you accounts, we're going to show you trades, we're going to show you what's happening. Again, entertainment purposes only, all the legal disclosures, see that in the show notes, but it's going to be fun, and we look forward to sharing that with you. If you have any comments or suggestions or things you want to see at any point in time, by all means, it's the people's show, as Saeed would say, and you are always welcome to bring comments, thoughts, and suggestions into that. What else we got here? Saeed, yeah, you being a YouTuber is still in the comments. It's hilarious to me. All right, so let's spend some time finishing up the sector analysis. I think it's important to look at these here. Let's go to the consumer sector. I believe this will continue to perform well, particularly as consumer discretionary spending on the luxury items continues to decrease and the savings rate continues to decrease. I think you're going to start seeing more strength in Walmart, Target, Costco, Home Depot, and Dollar General, particularly as people get more stuck in their homes with the current market, even though the lock-in effect could not get possibly worse in some people's minds. I think that it can. Let's go to the industrials. Caterpillar, Deere, General Electric, Union Pacific, 3M, all a mixed day on these. These are real economy signals letting you know how strong the real economy is. Is there this whole backside of the economy behind homes, behind Home Depot that is really building the next level of America, if you will. And I'm watering that down a whole lot. It's colloquial. You bear with me. But yeah, it seems to be a pretty mellow day. Nothing here. Energy, it's one of our favorite sectors. We think this is going to have some really, really good days. This is finally showing the impacts of what is a reasonable wartime response. Exxon, Chevron, Conoco, Schlumberger, EOG Resources, all seem to be taking it in the shorts today. And you would expect this. The Strait of Hormuz is effectively shut down, although is it? We don't know. We'll get into that here shortly on why there's a little bit of hide the sausage going on here on what's really going on politically and how this should be affecting the market. This is normal. This did not happen on Monday, which was stunning to me. So this happening tells me the market is starting to accept a little bit of reality, but is still drinking the Kool-Aid, if you will. Defensive positions. We always believe that when the market goes into capital preservation and the defensive risk-off liquidation mode and the market status, that you will see money's flight to safety. These are our self-identified safety stocks: Procter & Gamble, Coca-Cola, Johnson & Johnson, NextEra Energy, and Duke Energy. Although I should probably move those into the energy sector. Maybe. I got to figure it out. But I'm pretty comfortable with where these are at from a preservation perspective. All right. Let's get into sexy time, shall we? I'll spend a little bit of time here going over comments, see if we got anybody else here. Vic, quick question. Happy to be here. I'm glad you're here. Do you think that the closure of the Strait of Hormuz will lead to a drastic spike in energy prices? We're going to talk about that here in a minute, and we're going to spend some time on it. What up, Cena? How you doing, Big Sexy? Welcome to the show. Yes, we're going to talk a little bit about that coming up, and I'm going to actually talk a little bit more about the insurance aspect of that, where the oil is going, and what that's really meaning for the energy prices in the United States from just an overall objective financial opinion. A lot of people are going to try to read into that from a political perspective, but that is not the intention, and that is not what we're going to be doing here. So before we get that, let's, oh, look at this. We even got Saeed making comments in the chat again. Saeed getting all chatty Cathy over here. What do we got here? We are excited to roll it out soon. Talking about the alpha, baby. Talking about the alpha. It's going to be amazing. It should be fun, and I hope to not be poor after we roll it out. So there's that. Let's spend some time going over XAI, and it always requires a little bit of explanation. We use AI to go over and review the trending topics on all of the major social platforms, including X and Instagram. To do this, we put together what we think is a consensus of the major trending topics by you in real time at the start of the show, and we use this to come up with AI insights as well as a controversy score. That is what we tend to use as our jump-off point whenever we actually go out to these platforms and kind of scroll through the feed to see what's popular right now for you and I to realize how the social response is to the rhetoric that we're seeing on some place like, for example, CNBC. One of the challenges we've always felt that is in a live real-time market is that the real-time market is speaking at you, not with you. We hope that this, in part, bridges that gap. So number one, of course, the most obvious thing that is in the headlines right now, the Strait of Hormuz crisis. Tanker traffic through the Strait of Hormuz has dropped 92% amid Iran's attacks on oil vessels, marking one of the largest drops in modern history. Meaningful. Stay with me. We're going to dive a little bit deeper on this one here. Despite the dramatic shipping disruption, markets are pricing out geopolitical risk premium, suggesting that traders see this as temporary. Energy stocks may be undervalued given supply chain crisis risk. Now, and this is seems to have a consensus opinion, which is even more shocking to me, that this seems to be the general overall opinion. This is going to have an impact on the energy oil sector. It's got an elevated risk, high volatility, and there's a 450% spike in this topic in the day. And let me explain to you why. So the White House has come out and said recently that because of the constraint in the Strait of Hormuz, where, and this is interesting because I read, again, so bear with me here, asterisk. It's hard to tell what's information, disinformation. Everything I read to you has generally been verified by at least a couple media outlets, but I use the word verify loosely. The Strait of Hormuz is where 84% of, well, frankly, 80% of the oil that China uses goes through there. Only about 4% of the oil that goes through there really comes to us, the U.S. So the U.S. has now said it's going to use the U.S. Navy and provide insurance because Lloyd's of London has pulled insurance from those companies. So a lot of people who are shipping companies shipping oil through there don't want to ship through there because uninsured now that Lloyd's of London has pulled out. So the U.S. is now saying and said on a press conference that they are going to use one of their vehicles to fund insurance to cover those tankers, and they're going to provide U.S. Navy support through the Strait of Hormuz. That to me was fascinating because really the biggest export from that region is going to be oil, and 80% of that oil goes to China. China, who the president is meeting with in just 2 weeks, President Xi, which from China, which that meeting may or may not be canceled at this particular juncture. At least that's the upcoming fodder. But why are we spending U.S. dollars and U.S. resources to allow that to happen through the Strait of Hormuz and facilitate oil getting to China? I mean, we do have partners out there in that they're outside of Iran right now. There are a lot of partners who are currently trade partners, and for example, the UAE, Doha, Qatar, I mean, Kuwait. They're all in that area, and there's lots of oil coming to the strait. The other thing is this including tankers going the other way? You know, water is a big problem in the Middle East, especially if you're reliant on desalination plants. If Iran were to bomb those areas in the Middle East, a lot of those countries would have a water issue almost overnight. So the question remains: why are we doing this? Are we doing this to facilitate that for other countries, or are we doing that to facilitate a relationship with China? You know, this is right now an air war. Now we got people obviously in the water there. Will ground troops make its way to Iran? How will that impact the markets? I don't know. A lot of confusing things happening right now, lots of questions. But what I found to be really fascinating is right before the market opened this morning, and for those of you who know me well, you know that I'm typically up around 3 a.m., 4-ish a.m., and I'm usually checking the headlines. Right before the market opened today, we started seeing headlines of potential peace talks coming out of Iran. And let me see if I can find it real quick. And I thought that timing was wild because you had Korean markets tumble. A lot of Asian markets took a massive hit yesterday, in large part response to the war. Something I would expect the U.S. market to do, but has not really meaningfully done, even despite the volatility yesterday. And then right before the market opens today, which should have seen the reverberating impacts of those Asian markets in the U.S. market, this statement comes out about Iran interested in peace talks, right? So let me see if I can find it here. Active negotiations. Yeah, I don't see it right now. Maybe we'll find it on the social platform whenever we run. But basically, there was some leaked information out of the New York Times, which basically suggested that Iran was interested in via a proxy. I mean, they said somebody. Let me see. The New York Times. Iran interested in peace talk. Let's see here. 22 minutes ago, Iran escalates retaliatory strikes as U.S. signals long battle. And latest turn from talks 2 days ago. Okay, it's 20 hours ago. So nothing meaningful here. So it's interesting. That headline made the rounds, and I do have pictures of it, so we'll share that. And yet here we are with no visible finding of it on Google. And that seems to have shifted the market into this optimism that this is not going to be a continued prolonged war, which is weird, right? But the market opens up in a relatively positive fashion. If I go back to the market status, which is wild, we're now in a tech-led narrow rally. We've shifted up. The actual market is improving on the day. What the actual fuck? Like, what's going on? We are literally in a war. We're supposed to see volatility, and we start the market off a little slow, but then now we're popping back into a narrow tech-led rally. And I understand that Apple came out today. NVIDIA's had some conversation. But what the hell, man? Who would have... This is burying your head in the sand from a business perspective and saying, you know what? We don't think this is going to be a prolonged escalation when everything around you is suggesting this is going to be a prolonged escalation. It's just a level of insanity. Let's see, Saeed got some comments here. Real time speaking at you, so fancy. Yeah, 20% of the supply. Yeah, that's true. Let me check Instagram. I haven't been over there a little bit. Vic, I hope that answered your question, by the way. I don't know if that works or not, but we'll see here. Let's go to the rest of the XAI stuff. I want to spend a little bit more time on some of the headlines before we go in here. Market, this, believe it or not, this is going to blow your mind. This is tripping me out here. Market rally recovery. So this is the number one headline, straight up from Hormuz crisis. The number two headline on social media. This is where you got to ask yourself, is this being manipulated? Market rally recovery? Are we insane? What? AI statement on this, the market S&P 500 is now positive since the Iran conflict began, with the Nasdaq up 1.2% and markets within 2% of record highs despite geopolitical tensions. Why? Someone tell me why. That's insane. The market's ability to shrug off major geopolitical events suggests either extreme complacency, yes, or strong underlying fundamentals. Okay. Do I really got to be the asshole who says, what strong underlying fundamentals? Okay. The Mag 7 has led the S&P for the last year. And yes, small caps are performing incrementally better today. Fine. Okay. And yes, we are seeing, higher earnings we've seen before, but less dividends and way more capex. We have got this revolutionary technology, which is fine. Again, if you saw our last show, episode 324, we talked about AI. We talked about how this is impacting the markets and how it's a real threat to humanity. And you are, in fact, training your replacement. Yes, there's, I guess, reason for optimism in the markets from an efficiency perspective. But are we going to ignore war? Are we going to ignore the implications of war, which I understand long term generally helps the stock market, but near term volatility is supposed to be, that's the concept. You're supposed to, the VIX, the fear gauge is supposed to make you afraid. It's supposed to show increased fear. We saw it pop from 19 to 20. What? Bruh. So people aren't really afraid because they don't believe it. The sentiment, it's a level of like insanity that I don't fully understand. How everybody's looking at what's going on right now, going like, this is concerning. This is. Have you seen the hypersonic missiles that Iran has used on Israel? And I mean, 9,000 to 11,000 miles an hour can be fired from the back of a moving vehicle. That's scary. Okay, I don't care whose side of the aisle you're on or who you support or who you don't, politically, religiously, whatever. Do you? I respect all that, but that's scary stuff. Scary stuff. And the market is not showing fears in the stock market. And we are a finance-based show. And that to me is even scarier. The fact that we have this deniability of the real world situation. And maybe we're in the age of social media where people just like they can spin this rhetoric up. Or maybe, just maybe, the market's manipulated or the narrative's being manipulated and people are being manipulated because they can't, it's all too big to fail now. Maybe that's what it is. I don't have an answer. I wish I did. Let's talk about the third trending thing here, which is more reasonable. NVIDIA's investment strategy. NVIDIA CEO Jensen states OpenAI and Anthropic deals are probably in final rounds with no $100 billion investment opportunity on the cards due to IPO limitations. And that's probably good. We've had enough of this. Hey, you give me 100 billion, I'll give you 100 billion. Everybody's got the higher multiples. Yay, we're worth trillions. And it's nonsensical. NVIDIA's strategic investment limitations could signal maturation of AI sector partnerships. Stocks up 2.41%. We saw that on the sector analysis when we looked at the mega caps, which suggests the market views this as strategic discipline rather than missed opportunity. I think that's probably a fair analysis of that, if you want my honest opinion, which, I mean, if you're watching the show, you would think you would want my honest opinion. But let's look at the sector here. So yeah, NVIDIA is still up on the day. So that explains that. I've got to spend some time looking at NVIDIA to see why they've popped up. Well, not NVIDIA, Amazon, to see why they popped up. But yeah, that looks about right. So not really too worried about about that from the XAI and the crypto market recovery. This should come as no surprise what we already covered. What's happening with Coinbase, what happened with Kraken, which we're going to spend some time on here as soon as we get into this segment. The crypto recovery coinciding with geopolitical tensions suggests digital assets may be gaining safe haven status alongside traditional risk on behavior. We are seeing this in Iran, where there's a lot of crypto activity coming out of that space. People going into crypto and pulling away from the Iranian economy because they're worried about their dollars being crushed in the context of a wartime situation, which I think is a reasonable fear. And I think that's, given that cryptocurrencies, this is the first time I think we've had a war where cryptocurrency is really a meaningful alternative that people can get their money into. I think that's probably a reasonable thing. The crypto recovery, at 73,000 versus 20,000 plus higher at a minimum. I don't know if I call it a recovery, but rebound, yes. Rebound, I'll call it that. All right, Fed chair nomination. We talked about this one as well. White House submits the official nomination for Kevin Warsh for Fed chair to Senate, signal potential monetary policy directional changes. Maybe not. I think that the overall probability right now by most people is one rate cut at most. Some people are saying two could happen. JP Morgan Chase has not updated their estimates at 0 rate cuts this year and 1 rate increase next year. The Ghost original. Who knew? Yeah. All right. Warsh nomination suggests that a more hawkish Fed stance could be ahead, with 10-year yield remaining stable despite geopolitical events, indicates that market confidence in monetary policy is continuity. Notice a theme here. You notice the theme of this market confidence. Everything appears to be stable. Not a big deal. Yeah, me too. Bullshit. Sorry. But it's happening, and that's the reality. Okay, so look, you got to live with the world you got, is what we're going to deal with here. And as much as I would love to give you some good signs and explanation as to what and why and how, I don't have any good answers for you. What up, Corey? What up? Let's see here. We got a bunch of people out here on the Instagram side. I see you. I appreciate you guys all tuning into the show. Let me get back over to Langley. Not sure what you're talking about. The matter versus Iran. Ranting doesn't argue or accomplish anything. Oh, look at this. I love it when people come in here. Okay. Welcome to the show, Langley. This is your first time here, clearly. Not sure what I'm talking about. What I'm talking about is the financial implications of the market. Okay. Let me break this down. Okay. In a traditional wartime environment, in a near-term scenario, volatility is a normalized part of any economic environment. It's a normal response to the uncertainty of war. Now, long-term wars are generally good for the stock market, which I would say is a normal response. The market versus Iran, ranting doesn't argue or accomplish anything. It's not ranting. As a matter of fact, go back and watch the first part of the show where we went over the market data. As a matter of fact, the entire show up into this rant portion here has been data-driven. Am I frustrated that we're seeing things that seem to be departing from traditional understanding of how the markets work? Yes. And that should concern you too, Langley. And the reason why is because the markets are acting in a way they have not traditionally acted. You need to have a logical and clear explanation as to why, or if we've learned nothing else, you have to ask yourself why this time is materially different than last time. And I don't have an answer to that portion, and the market does not appear to be acting logically. So I ask you, and I'll do this with data so you don't feel like personally attacked, because it's not a personal attack. I think it's a valid question for a first-time listener, and I could see, depending on where you tuned into the show, I look like an angry person. Let's go back to the market shot here, okay? This is the status of the market. We are in a wartime economy with troops not on the ground, but certainly attacking a country. We have major geopolitical conflict. Geopolitical conflict is typically not good for the sector, all right? I think this is a good baseline. We are in a narrow tech-led rally in all of the major indices, again, using the ETFs as a proxy, appear to be up. What is it that is propping the economy up? Well, clearly we know that GDP is what's expected to rise, but consumer spending is what lifted GDP, but we've seen an increase in government spending. Government spending is not good for inflation. So my ranting, my friend, is because this is not good for a number of reasons, not the least of which is inflation. Number one. Number two, you also have some job numbers that came out today, which seem to suggest that jobs are increasingly better than what people thought they were. Those job numbers, which we'll get into here a little bit in the show, so also take away pressure from the FOMC to cut interest rates. And if that's the case, so be it. I'm actually not a believer that the Fed needs to cut interest rates in the near future either. I think if anything, you hold and you wait and you be data dependent for a little bit longer. I'm not bearish or bullish, if you will. I'm just observationally looking at the data, and the data is lagging, but seems to suggest that the market does not need a rate cut. And well, they have a dual mandate: price stability and jobs. Price stability is the biggest in jeopardy, and that seems like inflation could be coming. So government spending, GDP, all these problems that we're seeing from this wartime effort is not helping. I think if you had more volatility, I think, if anything, it would probably get some rational behavior back in the markets, but the market acting irrationally continues to trend upward, okay? That's where I'm coming from, my friend. So don't take it personally. No one's ranting for no reason. We're ranting for material reasons. It's frustrating. So let's get into one of my favorite segments of the show. Let's get into the X review of social media, shall we? And I'm going to go to my platform here for a little bit, just because I posted some things that I want to share. Let's go into the X view. Here's social platform. Some of these hearings have been kind of wild right here. Iran ceasefire likely. This is an interesting one. Let's see what this is about here. Again, breaking: Iran agrees to ceasefire talks after top leaders' group chats hacked. Okay, I don't even know what that means. Let's get into that, shall we? Let's go to the widescreen. I'll make this big, and away we go.
A new development in the Iran war, as Iran has signaled they are prepared to agree to terms of a ceasefire after Marco Rubio announced today that the group chats of top Iranian officials had been infiltrated. Here is President Trump commenting earlier today from the White House.
It's bad news, these group chats. I mean, no man on earth wants his group chats with the boys released for everyone to see. It's locker room talk. You've heard me say that before? It's very embarrassing. And we had the CIA and Mossad infiltrate them months ago. And let me tell you what's in those group chats. It's bad. Of all the bad things the Iranians have done, the killings, the bombings, this is the worst by far.
I'm joined now by CNN senior correspondent Kevin Brown, live on the ground in Tel Aviv for more. Kevin, what more can you tell us about this story?
Thanks, Jake. The mood here has been tense, to say the least. However, it's appearing like some kind of resolution is on the horizon. The endless bombing campaign
Is he reading from a teleprompter?
from the Iranian regime have been put on pause since this news dropped. It's a story that is on par with the Israeli pager drama from 2 years ago, but this time a coordinated effort between the US and Israel. I'm being told that these group chats had been infiltrated for months, and there was serious internal debate in the White House and Knesset about whether or not to release them, as this would seriously violate international bro code and could potentially lead to retaliation against Israeli and American men. Dubbed Operation Epic Funny, these group chats, I'm told, include text.
What? Is this sarcasm? Yeah, this has got to be sarcasm, right? This is see. This is why you can't trust information. This is not real, right? That's sarcasm. This is not real. Someone tell me this has got to be Danny jokes. Okay, yeah, all right. My bad. I got pulled into some. That's what happens. Now I feel like this is how Rogan must feel like when you're playing stuff here. Okay, so that doesn't. AI is a crazy thing. Jesus, that got me. I'm a little bit surprised. Look at that. All right, let's get back to a normal show without the bullshit, shall we? Bitcoin rises above 74,000 for the first time since February. Let's look at my profile as to explain what that really is coming from. So I saw this morning, and I saw these back to back to back. By the time this morning I showed this, and I'll show you the screenshot here. Bitcoin was at 73. It's above 74 now. So you're seeing what I would call a pretty clear and healthy rally back. This was on the news, according to Yahoo Finance, that Kraken to become the first crypto firm to gain access to the Fed's core payment system. This is a meaningful change in the overall regulatory zeitgeist as it relates to the cryptocurrency structure. Up until recently, this has been a big no-no. The Fed has not been comfortable with it. The regulators, the OCC, the FDIC, and some of the other regulators have been very, very uncomfortable with something like this happening. So it'll be interesting to see how this works out. Of course, there are questions. Are they going to be allowed to lend? Will they be, lending on this is something that's allowable under federal regulation, but certainly giving them the ability to pass through the Fed's payment core system is going to give them a competitive advantage and make them a first mover. I think this is good. I think there'll be many, many more firms to follow. Speaking of following, I look at this as Robinhood Light, but Coinbase has now got access to launch stock trading. So Coinbase, which was originally a crypto-centric platform, has now got a structure which in my mind is beginning to look a lot more like Robinhood. The question that I still have to look into myself is do they have better or worse execution than someone like Robinhood does? Because that has always been a critique of Vlad's platform over there, as they try to democratize the space and deliver this product to the retail platform, first with stocks and then with crypto. Coinbase started with crypto and is now on the stock side, but they are starting to come together and be very similar product offerings. It'll be interesting to see how that all develops with time, but that's clearly driving the stock price in the sector. Let's look a little bit at the screenshot here of the crypto market. Let's take a look at where it's at. Okay, yeah, Bitcoin has come back down a little tiny bit, but still in the 73-ish range. I think that's going to continue to rise throughout the day based on this news, but we are nearing a bit of a session low. So we look like we were at, let's look here, let's see, 122 was its height from 1 year ago, and then today we should be in a relative high. Okay, there you are. So there's today's low. We are at a session high. I apologize for the difference there. So that's a pretty good chart if you're a crypto king. I'm sure Michael Saylor's getting a big sigh of relief right now in that things are not as wild as he once thought they were. All right. Ooh, bullish crypto bro selling a 7% bounce after a brutal 50% bump. Look, you can hate on the crypto space all you want, and I'm not necessarily sure I'm entirely a believer at this point, but I'm open-minded and objective about it. I think that's a pretty good return from where they could have been. And let's see here. There's some interesting stuff came up. So, Blue Bottle of Coffee acquired by Luckin for $400 million. Yeah. Many comments there. All right. First sinking of enemy ship by torpedo since World War II. Video released since the Pentagon shows the torpedo strike that sank an Iranian warship near Sri Lanka, roughly 1,000 miles from Iran's coastal waters in the Indian Ocean. Interesting. So, yeah. Marathon Asset Management Chief and CEO Bruce Richards explains why he thinks high-level software default rates could surge 15% alongside Bloomberg's Invest. Shall we hear him out? I think we shall.
For how oil and gas services would work. And number two, based upon all the capital that was raised, now all of a sudden capital dried up because the pricing structure collapsed. And so what we have in software is very similar. We have a technological change which is forever going to change how software is going to be priced. Now we should think about that industry. And based upon that technological change and how much leverage is in the broadly syndicated loan market, and then more importantly in the direct lending market, leveraging up these software companies, the capital's now drying up. And so what did we see as a result of that technological change in oil and gas? We saw a 15% default rate in the subsequent years, 2016 and 2017. So for me to say that software, which is the biggest sector within the direct lending business, couldn't get to a 15% default rate, I think is actually missing the mark, because I think that's exactly what's going to happen in years 27, and it has a chance of happening in 27 and 28 to have back-to-back years. So although the industries are very different, there's a lot of similarities when it comes to technology, changing how pricing structure works at a time when too much capital has been flooding into the sector.
Yeah, I think that's probably a fair analysis. I think that's probably an accurate discussion of the fear. I think that the private lending space, which has been a bit of a fodder on the pretty much everybody's radar as of late, is going to continue to increase that as well. So, yeah, I think default rates in some of these overpumped markets are real. So we've had 15 plus years of artificial interest rate deflation. You've got a market where you've had probably, I think this is not even arguable, you have had one of the most prosperous economic periods in history. Recessions typically last the same time as the peaks and valleys on the charts do, about 7 to 10 years from peak to peak, trough to trough. So typically speaking, the offsetting prosperous time would be about that. And we've seen, frankly, double the low and certainly more than 50% of the high at 15 years. It's reasonable, it's rational to expect that the markets will have a little bit of arrogance baked into them. And I think that's part of the reason why someone like Langley watches the show goes, why are you arguing? Why are you upset? It's because we've got this irrational exuberance, this bravado as it relates to the markets in what it should be. It's almost like it's coming across like the markets don't think they're capable of failing. And I think that's insane. We need to be self-aware enough of where the markets are and where the markets could go, that a correction is not a terrible thing and not wildly unexpected. We have not seen a flight to safety for a prolonged period of time. As a matter of fact, if you look at what we've seen as far as market shocks and using this war as a proxy, you get a day or two of volatility and then the narrative flips. And I worry a great deal of how social media is being weaponized against us in this context. And again, I've got nothing to say that's meaningfully going to back this up other than circumstantial evidence. But I will say that we need to accept that social media is being used against us to spin and use narratives. Look at me. I just fell victim to a spoof that looked very real and had it on the show. And I did not see it until it was too late. And that happens all the time. People don't always realize that it's a spoof. They don't always realize that it's wrong. I mean, this guy was overtly funny, so I guess it should have been a little more obvious. But you're getting fake war scenes. You're getting fake headlines. And it's not just war related. You get this all the time. People have reasons to manipulate the markets. And if they manipulate them from faceless accounts and social platforms, then they win and we lose, especially if it's a meaningful move. You start looking at Jane Street and you say, okay, well, Jane Street may have, and it's again alleged, been manipulating the price of crypto every day at 10 a.m. to better their position from a derivative trading platform. This is a big company. I guarantee you they are not the only ones, and that is not the only sector. So I worry that the market has this we can't lose mentality baked into it, and you've got these weaponized social narratives being used against us on social platforms that, yes, I do get upset, and yes, I do rant, because it's insane in some minutes to think that this can just happen arbitrarily. And frankly, there's real dollars behind this. And at some point in time, you can't go up in perpetuity. And we've seen a lot of that. Iran pranked the U.S. and Israel by placing painted jets at their bases instead of real aircraft. Iran had moved its actual jets underground before the war began. Again, how do you know it's real? Even this video can be completely faked with AI now. It's insane. It's absolutely nuts. Oh, there you go. There's the best use case of AI. I wonder if this guy can be a co-host on the show. Okay, let's see here. There was some stuff I wanted to cover. 30-year average, the spread falls back below 200 basis points. The average 30-year fixed mortgage rate today is 6.07. Same time last year, 6.70. I see this and I think to myself, yeah, let's look at this chart here. All right, so there's your average 30-day mortgage rate. This is from a friend over there, Lance Lambert, who does follow the show from time to time. Low at 5.999. That's what the lowest it got to. And we saw a high of 7.08. But today we are sitting in and around the 6.07 mark for the 30-year interest rate, which is a good rate. I know people are frustrated because 60% of people out there have mortgages in their home, 40% own cash. Of those 60%, another approximate 60% have mortgages at 5% or below. So 6% is not enough to move them off the lock-in effect, but it certainly is a good rate relative to the 8% average historically, although that average should likely be coming down with the last 15 years of artificial interest rate inflation. So this is a good rate. And I know that people want rates to go lower, and I understand why. And the reason why is the affordability crisis, right? You want to move the lever that has the most impact. Well, the rate has the most impact to home affordability, although I think long-term that drives up the cost of homes, not down. So we don't have a solution to the affordability crisis, and I think the mortgage rate solution is the easiest lever to pull, but sometimes the easiest things to do are not the best solutions, particularly not long-term. They need to figure out the supply piece and how to motivate the builders to want to build more. So yeah, there's a whole thing there. There's a push to cut capital gains on home sales, how it could impact the housing market. This is an interesting conversation. I was talking to somebody last night late about how 1031 exchanges several years ago used to be something that you could do for your primary residence, where you would take a tax-deferred 1031 exchange, not pay capital gains tax on the capital gains, which makes sense, right? Like you sell your home, it's appreciated because the single largest source of worth for most Americans is their equity they built in their home over time. So that is your single largest chunk of net worth. You want to not pay capital gains on it if it's going right back into another home and you're not actually getting the benefit of that money. That went away outside of a carve out. I want to say about $250,000 per vested owner. So if it's you and your wife, each of you get $250,000, and then above that you pay capital gains tax. I don't think there's a 1031 exchange still there. You can still do it on investment properties. However, if somebody is familiar with tax law, correct me. I'm not a subject matter expert there, but that's my understanding of it. I think that coming back for a full tax deferred exchange with the equity appreciation we've seen would be a component to making houses more affordable and something to think about. So if you sold your home, you pay no taxes on the capital gains. You can go into a bigger home using that bigger nest egg, if you will, in the current rate environment. That might be motivational enough to have some benefit. But again, not a tax expert, but that was just a kind of a wider conversation we were having earlier in the day. So that's it. We got 57 mark-ish. So good, Taylor Phillips. What's so good, my friend? Me being sassy, or me upsetting my friend Langley here, or just in general, the fact that I got Coley Clown on the show, which really bothers me a whole lot that it got the best of me. But thank you everybody for tuning in. It's been a long show. Oh, there's a Kraken master account. I want to hear what this is about. So bear with me. Well, let's go a little overtime, shall we? Let's do this. I want to do this. I want to go into this here. Let me mute this so you guys don't hear it when I play it. Go to the full screen, bring this bad boy up. I want to hear this, and I think you guys probably do too. Let's get into this.
Yes, and can now use safety and soundness standards, apply them to digital asset financial institutions like Kraken, and have partial access to the Fed, which allows them to begin integrating the U.S. dollar with digital assets. It really is going to be the future. In the future, you're going to see banks buying digital asset companies buying banks. So if you go into a bank, they can serve you both in fiat currencies like the U.S. dollar and digital assets like Bitcoin. It's going to create the 21st century financial services industry.
Yes and no. All the major banks already have access to crypto in some way, shape, or form, and have been playing around with this with their federal regulators. And those who are state member non-banks have it with their state regulators too. So I don't know that they're going to have a competitive advantage. If anything, I think the banks have a competitive advantage because they have the infrastructure for trading. Most of them have trading desks. They have the safety and soundness and the regulatory oversight down as much as the regulatory ratings can say that they do. And they're not beholden to new levels of compliance and risk and due diligence that the same the cryptocurrencies are going to have to adapt to. KYC, know your customer, all these things that are bank specific now become interesting, particularly for those who are used to the blockchain. So I think you got two cohorts here, right? You're going to have the large banks, right? And the large banks are going to be able to implement this quicker. They're going to have crypto in their platforms much faster than you're going to have the crypto companies be able to adopt all of the safety and soundness and regulation. I spent time in both worlds. And because of this, obviously the bulk of my career has been on this side. But I've done a lot of research and personal diving into this, as well as some legal research at the beginning of the ability to lend to institutions, the ability to take deposits, managing crypto wallets, and providing it as a service as well as an actual product. And I can tell you that I think that the idea is novel, but I think that most crypto companies are going to want to stay away from banking regulation because they're going to find that the hurdle from a compliance and risk perspective is very, very difficult, particularly based on their size. There's some flux in the size of what gets into the bank's institutional large programs for different regulators. But when you get over 10 billion in size, you got a different degree of focus on your different regulatory exam cycle, different audit cycle, and it becomes very, very cumbersome, where crypto companies, as of right now, have to worry about cybersecurity risk, have to worry about cold storage and things like that, but certainly nowhere near the level of compliance and due diligence risk that you would have to do as a bank. So unless they carve those things out and have blockchain specific requirements, which I really don't see with access to the safety and soundness like the senator referenced here, I think you're going to have it first act in a meaningful way, a scalable way, will be banks. Banks will own crypto with the lack of anonymity, and then you'll have the fintechs, which are crypto firms, which will have a level of anonymity built in. No different in my mind than what banks already do with lending and private credit does with lending, right? One's just going to have a little more risk baked into it for a little bit higher yield. The other one's going to be more safe and sound, but a lot more transparent, a lot more due diligence. That's where I think we wind up there. So, okay, well, with that, I think we're all my friends. Kevin Warsh being nominated, joined late. Yeah, I covered Kevin Warsh earlier. I don't think Kevin's going to be, all my friends. I don't think Kevin's going to be, at least objectively right now, as volatile as people think he's going to make him sound like. He's still got to get past some confirmation stuff, but I think if anything, his track record seems to suggest that he's one of the candidates I would have never expected the president to pick, because he seems to be more in Jerome Powell's camp than everybody else does. It'll be, you're never really going to know what you get until he gets into the office. But again, the dual mandate is jobs and price stability. Right now, you got inflation coming just because of the spending that we've seen from the government. So that's going to peak up a little bit, whether it's a blip or it's longer duration, who knows. And then there's jobs. And as much as I'm worried about jobs, we covered it on the show multiple times, the jobs data that came out today doesn't seem to suggest that there is a trending down, at least not consistently anyway. So remains to be seen. So I don't know that his first action will be to cut rates unless he's trying to curry political favor, because I don't know that the data will be there by June, July to support that. But we will see. It remains to be seen in my mind where his stance will be, and I hope to get more clarity from him in some kind of public statements as time goes by. But he's also not a fan of public statements and doesn't believe the FOMC should be talking as much as they should, which I agree, but I don't think you can put that genie back in the bottle from my perspective. So it remains to be seen. We'll see how it all does. Ouch, co-host out for the show. Yes, Saeed. Sorry, buddy. Love you. All right, everybody. Well, thanks for tuning in. It has been a fantastic show, other than for my friend Langley there, who hopefully will give us a second chance. If not, we lost a viewer for life. So sad. If you want to support the show, go to joinfridays.com. Use code HIGHER. You'll get $100 off your first order. Everything from GLP-1s to NAD+, and a lot of the peptides that I'm a big fan of. You do go through an actual doctor. You can do that via email, or you can do it in person, whatever you prefer. It is a sensational process and a great company we support. So that's how you support us. Or you can go to thspod.com, buy some merch. Until next time, everybody, you know that we love you, but I love you just a little bit more than Saeed does. Okay, bye.